Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Alibaba's stock by analyzing their financial statement and dissecting their financial ratios so we can determine if it's a buy or a sell. Alibaba is a giant internet retail company. It has three main websites: Taobao.com, Tmall.com, and Alibaba.com. Taobao.com offers customer-to-customer services where individuals or businesses can sell items on the site. It is similar to eBay, where it acts as an intermediary between buyers and sellers. It does not warehouse products and deliver them like Amazon does. Taobao is consistently in the top 10 most visited websites in the world. Tmall.com offers business-to-consumer services. Only the brand owner or authorized dealer can operate a Tmall store. For example, Tencent may use Tmall to sell its products. I would not be able to sell Tencent products on Tmall.com, but I could sell them on Amazon. Alibaba.com is one of the world's largest business-to-business marketplaces. Most transactions are processed using Alipay, which is similar to PayPal, although PayPal's total transactions is a fraction of Alipay. Alibaba is headquartered in Hangzhou, China, and was founded in 1999. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, London Stock Exchange, Zicha, Vienna, Swiss, Buenos Aires, Hong Kong, and Bulgaria Stock Exchange. Let's get started with the model. This is a large cap company, 225 billion market cap. They're trading at $87 a share, and they have 2.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see this company is a cash cow. They generate lots of cash flow. 28 billion in 2021. It did drop to 13 billion in 2022. It's up to 16 billion in the trailing 12 months. Since we're looking at the ticker that trades in the US, I converted all their numbers into US dollars. When we look at their financial statements later, they're all reported in Chinese yuan. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's been going down a lot. It was 21 billion in 2020 and 2021. Now it's 4 billion in the trailing 12 months. Revenue looks really good. That's a sales for the company. That went up from 76 billion way up to 130 billion. This is the company's income statement. The top line is the revenue, the sales. All their financials are in Chinese yuan. Even though it's spelled Y-U-A-N, it's not pronounced yuan. It's pronounced yuan. And that's really hard for me to say. I don't like doing videos on Alibaba because I have to say that word, and I always have difficulty. Their revenue for the full year 2022 was 850 billion. Their fiscal year end is in March. So sometime in May, we should get their 2023 year end numbers. Here's a breakdown of their revenue, the 850 billion, which is roughly 135 billion in US dollars. A quick way to convert from Chinese currency to US dollars is to divide by 7. 600 billion of their revenue was from Chinese commerce, 61 billion from international commerce, 40 billion from local consumer services. Sinow is 46 billion of revenue. Sinow is a really big company that was started by Alibaba. It's a global tracking system. Sinow is not responsible for actually shipping products. They partner with shipping companies from all over the world to track the cargo. It's mainly products that are shipped from China. I think if you're shipping within China, delivery is guaranteed within 24 hours. They have a pretty big cloud business, 75 billion of revenue, 12 billion US dollars. Amazon leads the way in cloud computing. They own 34% of the market. Then Microsoft Azure is 21%. Google is 11%. Then Alibaba is 5%. But 5% of a big and growing market is significant. They generated over 30 billion of revenue from digital media and entertainment. They own Youku, which is similar to YouTube, but it's much more dynamic and interactive for the consumer. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's up from 227 billion to 314 billion. Then you have operating expenses. These are the expenses not directly related to generating the revenue, such as marketing. Gross profit minus operating expenses gives you your operating income, and that's up a little bit from 93 billion to 104 billion. It looks like they've been adding a lot of debt. They paid 42 billion of interest on their debt. That's more than double from 2022. It's up about 9x from 2021. Then other income and expenses. These are all the gains or losses not part of the company's core operations. Their pre-tax income, taxes, their earnings from equity investments. These are their earnings or losses from investments in other companies. Then you have your net income, which is down a lot. It was 143 billion in 2021. Now it's only 25 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they were generating over 230 billion of cash flow in 2021. That's down to 161 billion, which is roughly like 23 billion US dollars. They're spending more and more on capex each year, 53 billion in 2022. Operating cash flow minus capex gives you your free cash flow. And you can see their free cash flow is down a lot from 2021. It's down about 40%. They bought back a ton of stock in 2022. 61 billion. That's close to 9 billion US dollars. When a company buys back its own common stock, that decreases the shares outstanding, makes your shares more valuable. I guess the stock price is so low, they took advantage of that low stock price, because the stock price came down about 70% the past 2 years. Let's look at the capital structure. 146 billion of equity, 24 billion of debt. They're 86% equity, 14% debt. And they could pay off all the debt with the cash on their balance sheet and still have 54 billion of cash left over. I gave them the highest whack on Finbox, 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 350 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $340 billion. We divide that by 2.6 billion shares, and we get a calculated stock price of 131. They're trading at 87, so they're trading at a 34% discount. It's a buy according to the model. Their revenue forecast for 2025 is over 1 trillion. When you convert that to US dollars, it's 160 billion. Their forecast for 2024 is 145 billion. 2023, it's 130 billion. I continue this trend into 2026, and I got 176 billion. That's how I got their future revenue estimates. And they convert on average 18% of their revenue into free cash flow. So I multiplied their future revenue estimates by 18%. That's how I got their future free cash flows. The website Simply Wall Street values the company at 91. They're saying it's 4% undervalued. 13 analysts priced this stock, and the average price target is 146. The low is 120. The high is 175. 43 more analysts priced this stock, and the average price target is 146. So it looks like pretty much everyone's saying the stock is pretty undervalued. This is where the stock has been trading the last 5 years. At the end of 2020, it broke through $300 a share. And then it got really low. I think it got down to $60. I picked it up around $80, and I was up about 20%. I think I got it around here in the beginning of 2022. But now I'm pretty much flat right now. It's come back down to the 80 range. Most Chinese stocks have tanked the past couple of years. This is not an anomaly. In the past 5 years, Baba is down 55%. JD.com is down 1%. Amazon is up 30%. And look at Pinduoduo, up 214%. So Alibaba is really lagging its competitors. They have a low beta 0.6, so the stock moves a lot less than the market. It's down 24% in the past 52 weeks, while the S&P is down 13%. The 52-week low is 58, the high is 126, and the stock is trading below its 50-day and 200-day moving average. Over 20 million shares are traded each day on this stock. Of the 2.6 billion shares outstanding, 2.1 billion are on float, 15% are held by institutions, and 2.5% of the shares are shorted. If you invested $10,000 into this company when they started trading in 2014, you'd be flat right now. At one point, you would have been over $30,000, but if you kept holding, you would have came right back down to where you started. 44% of the company is held by the general public, 37% by institutions, 14% by public companies, 4% by insiders, and 1.5% by private companies. They do employ lots of people, more than almost any other Chinese company. They currently have 240,000 workers. The large Japanese holding company SoftBank is the biggest shareholder at 14%. Masayoshi Son runs that company, and he's made some questionable investments. A lot of really bad investments that lost money. If it wasn't for this investment in this company, I don't know if his company would be around. He invested $20 million into Alibaba when they started, way before they IPO'd. At Alibaba's peak, his investment was worth $300 billion. That's an amazing return. He did sell a lot of his investment off, but he still owns 14% of the company, about $4 billion worth. The next biggest shareholder is Vanguard, then BlackRock, then the founder, Jack Ma, and then Norges Bank. The best way to look at ratios is to compare them to companies in the same industry. There are 46 companies in the same industry as Baba, and if Baba has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they rank second in market cap. The giant Amazon is first. I think Alibaba at one point got close to 800 billion market cap. They've come back down a lot. They spend a ton in CapEx. They have a really low debt to equity ratio. They generate a ton of free cash flow, more than anybody in this list. Amazon's negative. They have a really good price to book, a weak price to earnings, a really good price to free cash flow, and price to sales is a little worse than average. They generate lots of revenue. Look at JD, generates more revenue than Alibaba. That's interesting. They're still growing a lot. Their 5-year annual revenue growth rate is 29%, and they have a positive ROA and ROE. So to summarize, I have them trading at a 34% discount, and this is such a great company. The only risk is they're in China, and that can be pretty risky. That's what's holding down the stock price. But they're so important to the Chinese economy that I don't think the Chinese government will interfere that much with them. But there's always that concern in the back of people's minds. I rank their free cash flow 6 out of 10, their revenue 8 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.